loan is less than $10,000, then no tax update. Capital gains only come into play if it is a capital asset. One Bitcoin is worth $39,984.70 in US dollars. Ask Roger. Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. Hey everyone, I'm Roger Herring. I am the Investor's Accountant. Hey, it's great to be with you today. You know, last Friday, we did a seminar, and it was absolutely the best seminar that we've ever done. Great energy in the room, a lot of learning, a lot of very important and very relevant topics. And I want to share with you today one of the sections of the seminar, specifically the one that I called, It Ain't Your Mama's Pension Plan. Yeah, most Americans, they'd have no retirement savings. They got nothing out there. Well, oh, my business is my retirement. Baloney. That's not going to work, guys. You don't know what the economy is going to do. We got to have something out there. So today I wanted to talk about retirement plan options, and then I want to give you a strategy. All right? I'm not going to tell you what to go invest in, but I'm going to tell you how to set the vehicles up to do it. So here we go. All right. Let's talk about the types of plans that are out there and how much money you can put in them. All right, everybody knows the good old IRA. You can have it traditional or it can be Roth. And if you're under 50, you can put $6,500 in it. And if you're over 50, you get a catch-up contribution, so you can put in $7,500 in total. Then there's a SEP plan. Now, a SEP is a small business pension plan, self-employed pension plan, I believe is the correct terminology. It's been a while since I've looked. I could be wrong. But the SEP, you can put in 25% of your W-2. Or if you are a Schedule C or a partner, you can put in 25% of your compensation that is subject to self-employment tax. All right? And then there's the good old 401k that everybody knows and loves. 401k can be either Roth or traditional. And guess what? We get an employer match. And I'll tell you something. Starting this year, it can go to Roth too if you so desire. So, in a 401k, you can put up to $22,500 if you're under 50. With a catch-up contribution, if you're over 50, that's $30,000 you can put in. And obviously, there is the employer contribution. Now, there's also this wonderful little thing called a solo 401k. And the solo 401k is for a small business where the only employees are the owner, the spouse, or very close family. Okay? Now, in the solo K, you can defer as an individual the same $22,500 or $30,000 if you're over 50 or over. Plus, you get an employer match, which is 25% of your W-2, up to those maxes of $66,000 or $73,500. Okay? Now, Raj, can I have more than one 401k and an IRA? Sure you can. You can have any combination of these things as long as you stay within certain limits. All right, that's a whole other lesson. But here we go. The next question I'm always asked, do we want Roth or do we want traditional? So, IRA and 401ks, they can be either Roth or traditional. We got a choice. SEP is purely traditional. However, there is a, quote, back door that we can utilize to convert SEP contributions to Roth. Now, as I mentioned just before, thanks to the Law and Secure Act 2.0 passed last December, the employer match for a 401k can now go where? Into Roth. But it's going to be included in your income for that year. So here's what you got to ask yourself. Do I need a write-off right now? Or is tax-free on the back end going to be a much better idea? The next thing you need to ask yourself, if I got high income now and I need the write-off, will I have lower income sometime in the near future and that'll allow me to go ahead and convert, and I'm better off doing it this way. These are things you got to look at. You got to look at how old you are. You got to look at the rate of return. For most people, though, I can't put it any other way. Screw the deduction. Yeah, how many times have you heard the tax guys say that? Guys, that deduction in most circumstances is not worth giving up the back end tax-free distribution. Tax-free growth, tax-free distribution. That's the way to go most of the time, but everybody's different. You better seek professional advice. Now, I want you to fund your Roth IRA first and foremost, and I want you to do it every single year. And yes, you can have a Roth IRA and you can have a 401k at work. Well, Raj, I make too much money. Isn't there a phase out? Yeah, there's a phase out, but guess what? We got this wonderful thing called a back door. So here's what you do. You make a after-tax contribution to your traditional IRA, and then you immediately convert that to Roth. You see, there are limits on income for contributing to the Roth, but there are no limits on income for converting from traditional to Roth. Now, it works in many circumstances, but here's the deal. If you've got other traditional IRAs, that's going to make part of that conversion taxable, so we may not want to do that. What do we want to do? Well, if you've got a 401k, we could transfer those traditional IRAs into your traditional 401k, and now you can do the back door and no tax issues. Once again, seek professional advice. All right, here we go. Some things to know. Oh, number one, you can self-direct any of these retirement plans. Yeah, that means you don't have to be stuck with what Wall Street offers you. This means you can look at rental real estate. For that matter, did you know you could flip inside of your retirement plan? Just don't do more than 2 or 3 per year. Then it rises to the level of a business and triggers this nasty thing called unrelated business income taxes. There's also this thing called unrelated debt financed income. That's a whole other lesson. So before you start doing this, once again, talk to someone in the know. All right. Do you know, if you are an accredited investor with your retirement, you can invest in funds and syndications. And hey, I would rather have a 401k than an IRA any day of the week. Why would I rather have a 401k? Because the 401k is not subject to unrelated debt financed income. With a 401k, I can borrow money, buy rental properties, and I don't get taxed on that. You know what? You could even buy your dream home in a Roth. Yeah, you could. Treat it as a rental property or a short-term rental for a number of years, then distribute it to yourself tax-free. There it is. Now, you know, I said you could self-direct any of these. Guess what? You could also self-direct your HSA, which is really a slightly different version of a Roth, or you could self-direct a Coverdell education account. Yeah, everything can be self-directed, which means you don't have to rely on Wall Street. All right, I got a question that I have to ask my business owners out there. You have a business, why don't you use a Roth solo 401k? Why? It's a no-brainer, guys. Here's the deal. You need to be putting something aside for retirement. And you can still self-direct and do your investing and make smart decisions, grow this stuff totally tax-deferred, and get it out totally tax-free. So here is my strategy. I call this the Roth plan. The first thing I want to do every year is fund a Roth IRA for me and my spouse. As long as one of us has enough earned income, both of us can have a Roth IRA. Once again, if I make too much money, I'm going to use the backdoor strategy. Now, if you've got a W-2 job, what am I going to do? I am going to fund the Roth component of the IRA and get the employer match. Then I'm done. It's called match and out. Now, I'm going to elect to have the employer portion go also into the Roth component. Okay, what's next? If I qualify for an HSA, which means that I have to have a high deductible insurance policy, I can have an HSA. Well, Roger, my HSA is through work. It doesn't have to be. That's right. All you have to have is a qualifying health plan. And you can have your own HSA totally separate from what you got at work. You can put up to the max in it, between the two, up to the max. You don't have to distribute anything. You can start collecting receipts as of the day that thing came into play. And now what? Go out and invest it. Well, Raj, what can I do? Well, you could create an LLC and combine your HSA and your IRA and your solo K and go buy real estate. That's just one strategy. Now, with our side hustle, or if we are self-employed and have no employees, what are we going to do? We're going to fund our Roth Solo 401k. And then going forward, when we have the ability to do it, we're going to convert traditional to Roth. We want to move everything from a taxable format to a non-taxable format. That's the plan, guys. Now, this is a shorter segment that I've been taping lately, but it's an important segment. So I hope you enjoyed it, and I can't wait to see you again real soon. Till the next time, Roger out.